Spring has sprung in Metro Atlanta, and for us, the chop can mean one of two things. It's us getting excited about our Atlanta Braves or the water conditions at Lake Lanier or Altoona. Now, choppy water is rough water, and when it comes to investment, that's where many of our viewers and listeners find themselves at currently, and we're going to talk about it today. All right, grab your favorite mug. It's time for coffee with your retirement coach. Welcome back to Coffee with Your Retirement Coach. I'm Aaron, hanging out with these coaches behind our clipboards. And today with us, Randall J.
How you doing, Aaron?
Randy, thanks so much for being here. Nick Yeomans.
Hey, buddy.
On today's episode, we did kind of joke. In Georgia, when the water gets nice and the weather matches, we get out. We're on those jet skis. We're on those pontoon boats. We're taking advantage of all of the creeks, rivers, ponds, lakes. Georgia's got good ones. And that's a great time to talk about, the fact that sometimes the water can be rough. And when it comes to our investment strategies right now, the waters can feel rough. And how we strategize in these moments is super important.
Yeah, Aaron, I've got some of my best memories fishing on a pontoon boat with my grandfather, all right, Pops, okay? And we go out on that little pontoon, all my cousins, my brother and sister, and we'd fish, and it was just great. But the waters were calm, and it typically wasn't on like 4th of July week where you had 1,000 boats on, but it was calm, steady water, and we got wherever we wanted to go.
Yeah.
But, I think about the different types of boats I've been on in my life. I've been on sailboats. I've been on a Navy SEAL power raft. I've been on all kinds of different boats.
Sure.
But they were designed for different types of water.
Right.
And the kind of water we're in this economic environment, in our investment environment today,
It's not a pontoon moment.
It's not a pontoon boat moment.
Yeah.
We're going down rapids right now. And what I'd say is you don't take a sailboat down rapids. You need a different vehicle to get down those rapids.
Yeah.
And I think, there's a lot to glean from that because a lot of us want to set it, forget it, and hope everything works out. We're just not in that environment right now.
Yeah, I would agree with that.
That was a rare moment right there.
I want to soak that in.
I had to think about that. You do not take a sailboat, not intentionally. Not intentionally.
Yeah.
So let's talk today about how to manage your money, your finances, your assets in regards to what I have heard some recently referred to as a frothy market.
Oh, nice. I see what you did there.
Yeah, that was nice. Well, I think the first thing that we have to do, and Randy, I'm going to tee you up here. There are very different styles of investing, and there's a lot of different philosophy. Everyone's got a shinier whistle in terms of their investment methodology and strategy. And I thought what we do for our audience today is break down 3 different styles of management and kind of compare and contrast and kind of lean into more of our bias or belief. So, Randy, maybe you can walk us through. You've got passive asset allocation, active management, and tactical management. And I think a lot of people don't really understand the difference between those 3.
Well, it's great that you bring up that topic because I think the one thing I would say that maybe people don't want to hear, especially if you are really in one camp or another, is all these strategies work. They all work. Yeah. They just work differently and in different seasons, kind of like you were talking about different boats. So right now, the cyclical adjusted PE ratio called the CAPE index is at one of the highest spots it's ever been. And historically, when the CAPE index is this high, the real return on the market is 0 to minus 0.3. So that's like in a 10-year approach. Now, I'm not saying that to scare anybody, but let's talk about those 3 approaches. So a passive asset allocation diversifies a portfolio within some constraints. A lot of people refer to this as the Markowitz strategy or the asset allocation strategy, approaching things like, and again, I'll be careful about terminology, but maybe using Monte Carlo simulation. And the thing about this is it's always setting up a portfolio for success based on what happened in the past. So its real basis is, in the past, this asset allocation worked really well, so you reallocate to that portfolio, and then you just buy and hold. And by the way, that works really well. And the design of that came largely to include this transition that people were having from institutional investing to privately managing their 401k and their IRA. What I found about the passive asset allocation, where it does work over time, it doesn't work if you intervene. So the problem with passive asset allocation is it still exposes you to a fair amount of volatility. And so what happens in that environment when things don't go well, individual investors tend to want to bail on that strategy because it becomes too painful in drawdown markets, or markets where the bottom is lower than what they're comfortable with. And so it forces sometimes the manager of that portfolio or individuals to take action at exactly the wrong time, because
Sure.
investing is so counterintuitive. So what comes out of that next maybe is a more active management. And active management really needs to take into account what is the change that would occur. And when I ask investors typically, how does your portfolio manager, or how is the portfolio changed if it's an active management, I almost find nobody, like I would say I have found so far, nobody that really knows what the manager is doing, what the rationale behind it is. But this is where you're taking an approach, making adjustments along the way. And then there is kind of more of a style that we fall into, which is a tactical constrained portfolio. And so when you're doing changes and adjustments in the portfolio, it has to do with actually what's going on. We call that fact-based investing. But there's a discipline involved in how you would increase or decrease risk exposure to certain asset allocations. So indeed, it could replicate the passive asset allocation, but the difference would be, let's take 2022, when the government prior to 2022 said, hey, we're raising interest rates. So if you're an investor and you recognize that, that meant your passive asset allocation was doomed to have losses in the bond part of the portfolio, because that's what happens. So again,
Well, and to expand upon that, typically when interest rates go up, bond prices go down, which is
Right.
what you're talking about.
right. So we want to make sure that we don't get into the weeds too thick here. But basically what that meant is, if I could adjust a portfolio, like de-risk the fixed income part of the portfolio, because we have a known event coming, the government said with great confidence, here's what we're doing. That's not forecasting. That's not guessing. They're telling you what's going to do. And to Nick's point, this is what's going to happen. So if I look at the next 10 years with a CAPE index, again, cyclical adjusted price earnings ratio, where the performance in the stock market during that period of time is next to zero in the past when it's been this high, then a tactical model where you decide how much weight you want to put into different parts of the portfolio may allow you not only to have a smoother ride through difficulty, rough waters as you're putting it, but also take advantage when things calm down. So in this case, there might be a period of time where we could exploit that rough water situation and be prepared using technology, using tools to adjust the portfolio. And here's the big takeaway from this, if I could. If you're in a passive asset allocation and you could close your eyes and never look at your statement, you're going to win probably over the long haul. Active management, I'm a little iffy on that because it gets so out of whack sometimes. But a tactical, intentionally moved portfolio that takes advantage of the disruptions in the market, the price movement market, the difference between stocks and bonds and different seasons of the economy. What I think you can do with a portfolio like that is help people ride through the rough waters, because it is de-risking and re-risking the portfolio based on parameters that are predetermined, based on indicators like a GPS that allows some guidance. So, hey, up ahead is, a jam. There's a problem up ahead. Do you want to do nothing, or do you want to take, a side road? So that kind of approach allows people to stay invested. Here's what you don't want. You don't want somebody coming to you because you haven't done anything and they're in a more of a passive asset allocation, and they want you to take an action to de-risk the portfolio at a bottom of a market. And then their re-entry, and Nick, I've heard you talk about this before, is once the market's back up and everybody loves it, they're re-risking. So the tactical allocation strategy that we use allows us to make that adjustment so that people can sleep at night better. And when things are good, which will be, again, like the seasons, we'll be able to turn that on, that risk on and off. And both work, by the way.
Yeah.
Passive and tactical management both work. The big thing is we want to control both the performance of the portfolio, the allocation of the portfolio, but most importantly, we want to help clients navigate that emotionally. And so we've got to manage the relationship of emotion with sound portfolio management.
Yeah. Sounds to me like no matter the vessel that we're talking about, if it's a kayak or a raft, we're looking forward. If we're hanging our head over the side of the boat looking at the froth, we're not winning.
You want to say froth a lot, don't you?
Well, so here a couple things for our audience. One, doesn't matter what style investment you work with, there's no guarantee of future results. You can't guarantee it. We don't know what the future is going to hold. And while everyone's got bias, we have our own bias. We've seen our own successes. Past doesn't, it's not indicative of future performance. So that is just, to make sure that everyone knows, not all strategies are built the same. Not all managers are built the same. Not all the cost of the portfolios are the same. So seek wise counsel as you enter into making these determinations of what style makes the most sense for you.
Can I add something to that, Nick?
Sure.
I think whether it's your 401k, and I'll give you an experience I've seen people do over the years. I've been doing this for quite a while, as you might know. So somebody gets their 401k statement, and they're in an investment that had a 10% return last year, and it was a great year. And they look in that portfolio, and they could have picked an investment that last year, they look at the performance from last year, and it was up 20%. And they think to themselves, well, golly, I was in this crappy one that only did 10. I could have been in that good one that did 20. So they changed the portfolio to one that's 20, thinking that what happened in the past is going to happen in the future. That's the problem sometimes with an active management style that isn't taking into consideration other things like depressed markets. Things we're seeing right now where the emerging market and international market looks better than the U.S. market. And the thing is that a new, more permanent change where we've got risk on in the international market, or is that just a short-term reaction to the negativity of tariffs and things that are happening in the U.S. market? So that's why you need a coach and a guide that's been through these waters before. And if you're going to go down a rapid, you better have somebody who's a guide on there that's been down the rapids before.
And let me tell you, Randy, this resonates so good, especially, I'm thinking about an experience Suzette and I had in Hawaii. We were going to the Nepali coast, and we had to sign a waiver acknowledging that this was not a leisurely cruise. Okay, we get in this Navy SEAL power raft, and there are these cords that we have to hold on to for dear life. And I'm telling you, you are getting beat the heck up.
Did you pay for that?
Okay, we're not going to tell you about that. So Suzette and I are in 80% of the people, lost their junk on this, the first hour of this, cruise. But here was the power of it. One, this vessel was so nimble and so powerful, it could get into these really tight spaces. And I think about tactical portfolios being able to go where the opportunity is. Mm-hmm. And this raft was able to go into these caverns and it was strong enough to pull out against the tide. And it was really, really cool to be able to have that experience. The second thing is that our captain was an expert. They did 3 of these rides a day, every day for the last 10 years, grew up on the island, knew the caverns. They were an expert. Yeah. And as we're, hightailing it towards the end, towards the coast, it was interesting. We had, hundreds of these spinner dolphins all around us. And then she parks. I don't know if you can park a boat, but we stop. Next thing you know, way up in the water comes this whale, okay? And I'm talking, it's 100 yards from us. And its tail is sticking out. We're all looking in awe. And we realize that one wrong move right now, we're flattened. We're destroyed. And it slams its tail down. And within the next 3 minutes, another whale comes up, does the same thing. And we're seeing 3 or 4 humpback whales all around us, slamming their tails. And what I realized is I was so glad I got to experience that, but I was glad I was not, manning the boat. I was glad I wasn't steering. I wasn't the captain,
Right.
because I don't want to captain through that.
Yeah, I bet
right?
everybody else was glad too.
Yeah, but I think about if somebody going through retirement right now, having that person at the
That
wheel,
guide,
knowing how to steer to help you have these amazing experiences, but they've got the boat. They're helping you go through, all those the different caverns, the different tides, the different waters, because they're an expert.
Yeah.
And I think that's an area where a lot of people could really benefit today.
So 2 things that we want to take away from this. Number 1 is we want to, if all of this is confusing, have somebody help you identify your vessel.
Yeah.
Are you passive? Is it something where you're in a target dated fund in a 401k? Yes, that's passive. What else would be that? Are you tactical? Are you in a raft? Are you in a kayak? If you're in a canoe, get out.
Well, let me add something to that too. I think that is really important. It could be easily misunderstood. Changes in market conditions don't mean you just change your portfolio. You have to know what the rationale behind that is, and are you positioning yourself for safety or growth or taking an opportunity where there's a depressed section of the market?
Yeah.
So just moving your money around, like I was talking about the person with the 401k, doesn't recognize what the rationale was. But another version of this, if you don't mind, Nick, I've noticed that people will be attracted to a Warren Buffett or some of these phenomenal managers who really are amazing and very rare, I would say. But they're attracted to these managers when the managers are outperforming the market. And what you'll find is with different styles of money management, people are in and out of season, like a value investor versus a growth investor. And so what they'll do is they'll move their portfolio according to what's strong today, just like they might in their 401k. And so they could be with a great manager, but they never give that manager time to ride through the cycle that they're in. And so I don't know that this is a fact, but if you're in and out of something like a Warren Buffett's, Berkshire Hathaway type of fund, which again, we're not promoting or discarding, we're just saying if you're making these changes and you don't let that manager go through their seasons, then you may get no performance or negative performance working with a manager who has a great track record and will probably do great in the future. And that's why I'm saying whether it's a passive asset allocation that is active, or one that is tactical but designed, or more dynamic, which is what we typically use, a more dynamic portfolio, making intentional changes. All of those things work over the long haul, and you can make an argument for which one. I'm saying in this season, where the market is right now, being aware of the dynamics that are changing is probably important when you've got indicators that are suggesting that the waters are really rough and probably going to remain rough for a while. Typically, that index I'm talking about, that CAPE index, that cyclical adjusted price earnings ratio, stays high like that, and performance stays poor until something brings those PE ratios back in line. And so that's why we want to be very careful and on top of things as these markets change. And I think that anybody can ride through this. You just got to be careful right now in these waters that you aren't one of those people who are responding in the wrong way.
Let's talk about those riders for a minute, because every voyage is different. Now, if I'm accumulating, if I'm still working through these rough waters, if I experience a dip, I don't like it, but oftentimes I've got enough time to recover.
Yes.
Let's talk about the retirees that are drawing income from their assets, and they're in this moment, and it feels more like the boat's taken on water. Somebody has scuttled the ship.
Yeah, I would say one thing that I've noticed that we do, and we do it when you don't have to do it, and that is almost every one of our clients has a portion of their portfolio that is like their life vest. It's got the ability to ride through those rough waters because we've made it defensive by nature. So we may have a client that's a very aggressive investor. We're still going to suggest that a part of their portfolio, whether they want to do it or not, should be conservative, because when things look great, that's when you need to be worried.
Right.
When everything looks great, you need to realize that it won't stay great. So you should have a preparation for that, and vice versa. If you're fairly conservative, but you want to keep up with taxes and inflation, you probably should have a part of your portfolio different than the rest that could take advantage of the turbulence, the market volatility, and get a higher potential performance. So really educating the client and getting in sync with their unique needs and designing how their portfolio should be for what their needs are, what their income needs are, or future. And retirees more than anybody else needs this because they need confidence to ride through that. And if they see that there's a plan, here's what I've learned about that. When rough things happen like this, they know they've got a plan.
Yeah.
They're not you cannot coach and educate a client in the midst of rough waters if you haven't done it in advance. They're not ready to hear a strategy. All they're operating by then is fight or flight. And
Yeah.
that is, we want to take that risk away. And the way you take that risk away is education.
Yeah.
One of the things that I think about as we're thinking about retirees depending on their money today, Randy, like you said, that, life vest, life jacket kind of portfolio designed to help somebody survive a period of time like this, it adds confidence when you get on the boat. Like when you're going through a storm, it gives that confidence. Yeah. And a lot of people entering into retirement today, they either, I think, fall in one of two camps. They either have like very little to nothing that is set up to be a safeguard and to be able to give that monthly income, that monthly paycheck, or two, they have way too much in cash and safety that's not working for them. And I find that it's typically one of those two extremes, and there's
I think you're right.
Relatively like little balance there. And so one of the encouragements I might give our audience today is to reevaluate, do you have adequate defensive money that is designed to give income and weather the storm and be that life jacket? Or if, you are, all life jacket, no boat, perhaps you really need to be looking at what are your entry strategies right now. If everything is on sale, it doesn't mean that it won't go on clearance in the future, right? Yeah. There could be better buying opportunities in the future. Nobody knows that side of the table. We don't know that, but we know where things were a year ago, and we know where they are today. And I look at some great brand names and some sectors and asset classes that I would have loved to have owned, but just way too expensive today.
Yeah.
So now that they're on sale, I'm saying I don't want one. That's akin to me saying I want the car right now that has the 25% premium, on top of MSRP plus the 25% tariff on top of that. Like I want to buy that today. No.
That's a great analogy.
I want to wait until it goes on sale because there will be enough people not wanting to buy that car that the dealership's not going to be able to move it,
right.
And it is going to be on sale at some point in time in the future. And that's how I think we need to approach a lot of our assets today. I want a deal. It's like everywhere else in our life, we want a deal. Okay, but not here. For some reason, we're wired, because Randy, you say it all the time, investing's counterintuitive, but we want everything to be good before we get back in, and good means I'm willing to pay a premium. In a market like this, I've said it before, I was just on the New York Stock Exchange TV, and I said this, markets like this with the volatility that's happening today, it's like Christmas time. It's a gift for professional money managers because they can absolutely win in an environment like this because they can scoop up deals and opportunities. Winners win, and you got to win no matter what those waters look like.
So I've got two things to say as we could wrap up, okay? One of them is beware in rough waters of the advisor that put all of your money in the life vest. That locks you up and you can't get out of the life vest for 5 or 10 years because they do. There are some unscrupulous people out there that are doing that right now, and they use volatility to do it. The second thing is, Nick, I want you to make me a promise. You will do an episode for us on how to buy an automobile because you are absolutely the pro. I mean that. I think there'll be a lot of value in our upcoming episode to have Nick, you go through the logic of how to make a non-emotional purchase on something that it's the second biggest thing that most people buy other than their home is their automobile, and people make that mistake massively. You've helped many of our clients buy a vehicle. One of them I remember in particular where the person had already signed a contract. We had them go back, and you literally got $10,000 off the price they paid, $11,000. So I think That's content
Well,
too that people would really
and
like to
that
hear.
client coming back later and then singing your praises because it was just being trapped in that vehicle that it was past time to move on from, and coming in singing your praises about not only just the physical comfort but the peace of mind of now I'm not worried about breaking down on my way to run errands. It's great.
You going to do it?
I also
We can do it.
I wish we could rewrite this episode and it would be titled "All Vest No Vessel" or "Equal Vest to Vessel." I think that's great.
All right.
But just kind of keeping things moving. Nick, we have touched base on this, so we don't need to go too deep. We've talked about this in Fear is Not a Plan. We've talked about this in our Big Chicken episode. Don't be too conservative unnecessarily.
Yeah. Well, and I think that comes back to the whole idea, Aaron, of having all of your money, in that defensive or conservative posture in bank accounts and under your mattress or wherever, just because you're scared, you're afraid, you don't know what to do. And I don't mean that derogatory at all. That's a very real life thing that people experience. But what adds confidence is, I think there's two things: knowledge, okay, because knowledge brings understanding, and two, somebody in your corner.
Yeah.
Somebody that can help you walk through it. We just released an episode not long ago on widowhood, and how to walk somebody who's
Powerful.
going through that. Was powerful. Leanne
Yes.
Cartwright did a phenomenal job kind of exposing what that part of their life looks like. But the missing element for so many people is they don't have that person that's going to lock arms with them and help them go through. And so having too much money as safety is often because there's a lack of understanding, so there's fear. And two, there's not somebody to lock arms with you to help you walk through that period of time.
Yeah. A coach, and in some cases, a companion, a friend to come through and help navigate. What a powerful thing. And that's, we talked about the caddy when we did our live stream, and we talked about, the golf themed episode. Talk a little bit more, Nick, about when you go on a successful rafting excursion, there's a trained professional in the front, there's a trained professional in the back, and then there's everybody that they're worried about falling out in the middle.
Yeah. Well, I think, having, I had that experience on the Nepali coast in that Navy SEAL raft. At the end of the day, having the expert guide you, you can have some amazing experiences in your life. But sometimes we don't know if we have a good captain or a bad captain. And sometimes we don't know how many at-bats they've had. We don't know whether they've had, 150 excursions or this is their second one.
Yeah.
And, here at Yeomans, your retirement coach, this is what we do. Yeah. We help people who are within 3 to 5 years of retirement transition into retirement, or if you're already retired, optimize your situation to help you pay less taxes, make sure your estate is in order, and make sure that portfolio lines up. And so we work with people who are in that retirement life and helping them optimize it to make it the best it can be. I mean, that's what we do, right? Yeah. That's who we serve. And so find that expert.
Yeah, and I would say if you're just not going to find an expert, if you're going to do this on your own, and we know some people will, we want to share openly with you. You should have a 3 to 5 year strategy, which is your, safety money. You should have a certain amount of money that you need to live on that can weather all the volatility in that, so you don't get sucked into doing zigging when you should zag. And then to the degree, the rest of that portfolio could be conservative, moderate, or aggressive, depending on your nature. But everybody should have a little bit of money that's defensive in their overall financial plan, especially as you enter retirement. You want to have confidence. And I think that's a great way to feel that you can go through this period. And if you've done that kind of planning in advance and these things occur, and they occur about every 4 years, then you're okay, because you're going to be able to ride through that with some confidence, and you're not going to feel the necessity to make a bad decision.
Yeah. Well, and guys, I think there's been a lot of wisdom shared today. I think this has been a great episode. Hopefully our audience has felt the same way. But I really appreciate you sharing, because I think there's so much to glean. I mean, this is the kind of content that I think encourages people to take really right next steps.
There were people that might have come into this episode feeling like they were up a creek, but now they have a paddle.
Oh my gosh.
See what I did there?
Well played.
Nice. Nick, do me a favor. Give us, if we did talk about a lot and we did kind of tread into deep waters, if you will, what would be some really good takeaways that you would say, hey, look, make sure these are the things that you got from this episode?
Well, I think the first thing is understanding that there's different methodology, there's different tactics and strategies that can be used to help you navigate these waters. As Randy did a great job earlier of discussing passive versus active versus tactical or dynamic. What resonates with you in going through various periods of time, good times, bad times? What keeps you working your plan? I think number 2 is, retirement investing is not the same as when you're working. When you're accumulating, you're investing very, very differently than when you're retiring and you're living on your money, or maybe you're not even living on your money, but as many of our clients, they're forced into taxation through required distributions.
Yeah.
Well, you absolutely design those types of portfolios different than when, again, you were accumulating your 401k. I think third, don't be too conservative. I think there's nothing wrong with being defensive, but relying on the life jacket as the sole way you're going to navigate through waters right now, I think is a big mistake.
Yep.
But being intentional, getting the guide or the captain to help you know how to navigate these waters is a much better decision.
Yeah.
Number 4, I think taxes are likely going to be one of the most important expenses to understand in retirement, and to try to mitigate those. That's, you were talking about at the top of the episode, choppy waters. That is taxes.
Yeah.
Taxes will go up and they will go down. It is important to have that 3 to 5 year tax plan in place to know that 3 to 5 years from now, where do I want to be from a tax position?
Yeah.
And these are probably, the next 3 or 4 years are very critical to doing that, because we get a sense of where taxes are going to be. And I think this is a time to really have a plan for the next few years.
Sure.
Yep. And then the last thing is, I think the second opinion. At the end of the day, this is, most of the clients we work with, you're not going to get a second at bat.
Yeah.
Like, you're not going to get a do-over.
Right.
What you have is what you have.
Right.
If you're a 100,000-aire or a 10 millionaire, it doesn't matter. What you have is what you have, and it's important. So making sure you've got the right captain and you've got the right vessel to go through the right waters, having that team lined up, it's so important. So I'd say, if you don't currently have, really excellent confidence in what you're doing today, one of the best things you can do is surround yourself with people that they've got your back, they're fiduciaries, and they've done this more than twice.
So where are you? What's your vessel? Are you a canoe in the rapids? Would you like to email us at connect@yourretirementcoach.com? Hit us with some specific questions. Find out how these rough waters might or might not be affecting you and your plan. We would love for you to reach out. Again, if you've enjoyed this episode, previous episodes, you've got an idea for a future episode, please take advantage of that email, connect@yourretirementcoach.com. If you've enjoyed this and you want more to head your way, don't forget to subscribe on whatever platform you are consuming. If you're listening or watching, we appreciate you being here and want to thank you for being coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeomans Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. This podcast was filmed at Podium Studios at Marietta Square. Grow your business with turnkey, professional quality podcasting, live streaming, and online events. Don't worry about editing. Don't worry about anything. Just come in and record. Learn more at thepodium.studio. Step up to the podium.